Hi, and welcome to Web3 Unfiltered, the podcast that cuts through hype and explores what actually works in finance, Web3, business, and emerging technology. I am your host, Collins Odabi. For those building in Web3 and digital first markets, understanding how capital is assessed outside traditional banking system is crucial and critical. Whether funding comes from private lenders, decentralized platforms, or institutional channels, the underlying question remains the same. How is risk evaluated? And what makes a venture truly fundable? Today's conversation explores those fundamentals. Joining us today is Louis Bachour, a private lender and investor who has deployed millions into small businesses and founders operating in markets traditional banks often refuse to touch. Where banks see red flags, Louis sees nuance. Where spreadsheets looks messy, he looks for signal inside the story. Today, we will talk about how capital really moves, how risk is assessed outside institutional frameworks, what makes a deal fundable even when the numbers aren't perfect, and what founders need to understand when seeking alternative financing. Welcome to the show, Louis. How are you doing today?
Thank you very much for having me. I'm very good. How are you?
I am fine. Thank you so much for asking. All right, Louis, I like to ask my guests about themselves first. I like to know their story, how they got to where they are today. So that would
Mhm.
be where we'd start from. What is your story? How did you get to where you are today?
So I actually started my very first like financial activity was selling in-game currencies for real money. A little bit like the crypto games today. And I was basically a young guy, playing video games, and I was farming basically in-game currency and selling it for a real currency. And that was my very first financial activity. And then, all sorts of little things. And then it brings me to high school. And then in high school, I started with small amounts, lending money to friends. Of course, back then, the amounts were very small, no contracts, no collateral. I wasn't asking about balance sheets, I wasn't asking about income statements. So it was more of a trust link more than anything. And then years after that, I started investing and trading through the stock markets and forex markets. And as the years passed, my lending activities and trading activities grew in size and just kind of snowballed. So that's kind of the high level view of the past, let's say, 15 years of my life. A short summary.
Amazing. You started off with what a lot of persons are into today. And it's actually really nice because I think many people can see a part in what you're doing. And if they're interested, I think they can also go through that same route. So let's look at the reality of private lending. Most people understand bank loans, but what actually is private lending?
So, private lending is, by definition, loans coming from a private individual and, or let's say, a private entity, like outside of the banking system. And, or there's also alternative lender as a way to call it. I choose the private lender term generally for no specific reason. Alternative lender is good as well. And that's what it means by definition. So it doesn't come from a bank, so it's not subject to, the approval of a certain board of directors. It's not subject to certain quotas. It's not subject to, it's basically only subject to what the private individual will ask.
Okay, thank you for the explanation. What type of deals do banks reject that you're willing to consider? Because I understand some people have to go to the bank first, and when they are rejected, they sort of look for a private lender like yourself. So, what kind of deals do bank reject that you're willing to consider?
They reject a bunch of stuff, and the stuff that I'm willing to consider is, for example, companies who sometimes would get approved by the bank, but they simply can't get the process going and finalized quickly enough. If you start the process with a bank, it will last weeks, easily 4, 5, 6 weeks. And for complex cases, even more than that. However, if I'm able to assess the situation really quickly, let's say in a weekend or in a couple of days, I can approve that loan basically. Um, so I will look at everything, I will ask all my questions, and then I know what kind of stuff goes through a bank. So I have a good feeling about what's going to get approved and what's going to get rejected. So if I look at it and I think it would get approved, for example, but that the company needs money in 2 days or in 2 business days, then it's impossible to get it from the bank unless you have some sort of like crazy privilege. It doesn't really work. So those 6 weeks could be deadly for a small company. You may bounce on your payroll. So your employees expecting a pay every 2 weeks may receive no pay by surprise on that specific payday. And that's a killer for a small company. A lot of people already kind of don't see small companies as a stable employment. They kind of see it as a short term or riskier employment. So if you bounce on a payroll and your team doesn't receive their money on the payday, you may lose a lot of them, or the trust will fall immediately. They'll think that this is a persistent risk. So that's one way to approve a loan that the bank hasn't even covered yet. And some companies are clever enough to know that they're not going to get approved quickly, so they go directly to private lenders. So sometimes private lenders come before the bank. It's not like it's going to last forever in the sense that if the company eventually gets approved for a loan, then that's very good. They won't need private lenders, but sometimes they'll still need, just because the amount approved by the bank is too small. And that brings me to another way of approving a loan that the bank sort of half approved. And what I mean by half approved is the company needs $100,000 and the bank gives them a $15,000 line of credit as a middle ground. So a company that makes sense, but the bank needs more history, often will get approved for super small amounts. And the company will still need the help of private lenders. And leads me to my third way to approve loans that the bank won't, is if the company is very recent. Let's say I know people and entrepreneurs from like 8 years ago. I know how they operate. I know how they succeed in challenges. And then they start a new company. And then they go to the bank for a loan. And then the bank says you've been in operations for less than a year or less than 2 years. You've only been in operations for 6 months. We can't take you. And from my perspective, I've had a relation with the founder or the founders. Sometimes there's multiple people for 8 or 10 years. So I get an advantage over the bank because I already know how these guys operate. I already know this, all the stories. So I get a head start. You know, when the bank will start a relation with a prospective client, it starts when the loan is asked for. So that's a very, very recent relationship. versus a multi-year one that private lenders can have if they have an extensive network. So those are three good ways to accept a loan that the bank refuses.
All right. Amazing. This is very interesting to know. It is. I was going to ask a question earlier, but I think you already answered that. I was going to ask, when you look at a messy business on paper, what is the first thing you assess? But then you talked about a lot of things, the timeline when the company was established and
Mhm.
the circumstances concerning or surrounding the need for the loan.
So when it's messy on paper, it's actually my job as a private lender to structure it on paper. And if, you know, so many small companies, they don't really have a bookkeeper. They so they don't do bookkeeping, they don't do accounting. They try to do tax reporting at the end of the year and just scramble to do it. Um, so a lot of the times it's messy on paper. But that's actually an opportunity because when they try to go to the bank with a totally messy presentation and messy numbers, the banks will see that as a red flag, or like as a weak point. And then if the amount is like a small amount of money, like $20,000 or $30,000, it'll go to the bottom of the priorities of that bank. The people running the lending department will just spend their time on more lucrative deals. And those kind of deals will just slack. I've seen it happen many times. Businesses waiting, weeks for followbacks. So, as a private lender, I have to come in, and if the business is not sure about the numbers, I have to sort of ask the correct questions, look at whatever number they have, kind of structure it myself. So that's the first thing I would do is actually structure it. If it's messy on paper, I need to structure it on paper, at least internally for myself. So I need to come up with at least a skeleton of income statement and a skeleton of balance sheet. Of course, it's not going to be as detailed as, a public company 10Q, but, because there aren't that many different expenses sometimes in those small companies. So you can group them quite easily. So when it's messy on paper, it is an opportunity, and it's my job to fix it on paper.
Fixing businesses on paper comes with a lot of risk because the company could be hiding something at the end of the day. The company could be going through something. You're not in the company, so how exactly do you manage to get so much information about what to do when you're structuring the messy business on paper?
On certain deals, I am in the company, in the sense that part of the deal will be that I help restructure the company, and it's something I get paid for. It's some stuff that I do, and of course, people can lie, and there have been, of course, when you're a private lender, people try themselves every month. Not the same people, but just different people. So my radar for scammers is super, super sophisticated. You know, I don't know if I can put that on a CV or something, but it is super sophisticated. I have a lot of experience at looking at public companies, private companies for equity investments, and private companies for lending. And I will accumulate a lot of information about their business, about what kind of stuff they do, also about themselves, of course. And often the founders will be people that either I know directly or I know through common friends and partners. So it's rare that it's a totally unknown person. Of course, as time goes and as I scale, there are a lot more unknown people in the pipeline, but that's to be expected. But I ask a lot of questions. I meet the people. I know a lot about the logistics around a lot of businesses, a lot of types of businesses. In lending, I mainly deal with e-commerce businesses. So I know a lot about logistically what it takes to run an e-commerce business, whether it's a digital product or a physical product, what questions to ask, what like details to know. And of course, people will try to lie once in a while. But my radar is really, really, really good. Not to brag too much, but my radar is really, really good for that.
You seem very confident, and I must commend that. You really do know your onions. So tell me, have you ever funded a deal that looked terrible at first, but turned out highly
Mhm.
profitable? Kindly walk us through it.
Yeah, actually, a lot of deals in private lending, every successful deal is a quite profitable deal because you're basically accepting or dealing with a lot of risk and uncertainty in the beginning. So you have to price each deal for a reasonable interest rate to compensate you for that risk. So every deal that I've done was a deal that could look bizarre a little bit on paper, but was actually profitable. And a lot of the cases are around, like I said, the founder really good, really strong, really organized, but terrible with the accounting and bookkeeping. So then the founder is not fully aware of how profitable or how unprofitable his company is. He moves really, really quickly and then get ahead of himself and incurs a ton of expenses that are smart expenses. They will yield a return for the business. But many examples where the founder gets ahead too much and you risk bouncing on your payroll day, so your employees may not get their money. Your suppliers, payment plans with suppliers that you're missing $40,000 and you need it by tomorrow because otherwise you'll have issues with your supplier. And when you look at a messy situation like that, on paper it kind of looks terrible. There's a lot of information missing, and you don't have a lot of time to kind of compile everything. So I've had a lot of deals where I would land, for example, $100,000 at a high interest rate for 2 months. And that's the time it took for the company to kind of reorganize itself and clean everything and then have enough money to carry their operations and then go to a bank with a better structure, which I also helped them do. So every single deal looks a little messy, and every successful one is a quite profitable one. And so far, I haven't had a losing deal, but I say no to just so many deals. I say no to probably over 95% of the deals. And I have a lot of repeat clients. So, for example, you start your business, first 6 months, you really run it really well. It's promising, everything's good. You go to the bank, they don't take you because the company's too recent. I lend you money, let's say for a 6-month deal. Let's say it's 50,000. Then at the end of the 6 months, I reevaluate your business. I look at all the information. I get access to your internal data. Could be your Shopify platform. I even have access to certain companies' bank accounts directly, which makes it harder for them to kind of falsify stuff. And then 6 months later, when it's time to renew, I can decide to keep the 50,000 if the company still needs it, and then increase the amount. I can send 100K or 200K if the company is still young but very profitable. So they don't even if my interest rate is higher than a bank, at least the company has money. It's good for them. It's good for the private lender. The company is much better having money and paying higher interest rate than a bank than just not having the money. So a lot of the deals are like that. It's a first test, still a trusted test, and then over time it scales. And then eventually, if the company is really good, they don't need a private lender anymore. They may still ask me for advice or for consulting and stuff like that, but not for capital anymore, or very rarely. So that's how I would answer this question.
It is amazing that even with the high risk in private lending compared to traditional finance, you've never had a losing deal. It's really amazing. Now, for founders who have been rejected by the banks, or if a founder has been rejected by the bank, how should they approach alternative or private lenders?
How should they approach? Well, first I think they should know one, which I guess not many first-time entrepreneurs have, private lenders in their contacts. But so they should look for private lenders, and then they should take all the data that they sent the bank and not try to hide that the bank rejected them, because that's kind of like a very obvious thing. So if they try to play as if they didn't apply to a bank, or the bank said yes, you know, that's a really, really bad first impression. I think they should right away just be honest and say that it didn't work with the bank. And I will probably be able to guess the reason within a 1 minute conversation, about how recent the company is and what are the numbers, what information did you give the bank. And then if they're honest and they have all the information plus the other stuff that I will ask, and the in-person meetings or Zoom meetings that we'll have, then they get a chance. Of course, it depends on the data. Everything depends on the data, but that's what they should do. Simply to be honest and deliver all the possible data and transparency right away.
All right then, amazing. Um, I am sure we have listeners who will find that information very useful, founders and the likes of them amongst our listeners. Okay, let's take a breather and step a bit away from private lending. Beyond private lending, I understand you trade. So what do you think about Forex, crypto, commodities, and gold?
Those are all different markets. So I'll kind of answer this way. Ultimately, I am a capital allocator. I'm not, you know, I can't simply say I'm a forex trader or stock market investor or private lender or commodities trader. I am a capital allocator, which means that my universe of possible investments is all those markets. So every day of my life, I question myself, what is going to be, the best thing to do in the next 6 months, the next year, the next 2 years, or even the next, few weeks. And if I think that lending will be the best strategy, I'll do it. If I think investing in a particular company in the stock market, if I think that's gonna beat the lending, that's what I'm gonna do. If I think I should invest in gold, then that's what I'll do. Of course, I've built this experience over more than 10 years, 10, 11 years. So these are markets that I'm used to, being in, and I'm used to the risk and I'm used to the exposure. So that's
Oh,
how I would answer this question. So I don't know if you have a follow-up question about that, or what answer you were looking for.
yes, you did justice to the question. Lastly, I would like to make emphasis on something. The idea of Web3 is built on decentralization. And in decentralization, we do know that most times, or in some cases, or in most cases, a system is not controlled by a private or a central entity. So, do you believe that decentralized finance or Web3 style funding models will change private lending long term?
Um, if it would change private lending long term, maybe it would ease the capital deployment speed. I'm not sure if it would actually ease all the other concerns, because you also need to evaluate collateral. If the deal has no collateral, then it's priced differently. And if they have collateral, then I assume that on Web3, you will need to put that like on chain and pledge it as a collateral or something like that. So, like short term, I don't think it's really doing anything in what I see because none of the private businesses that I deal with um, really know anything about it. And they would basically panic to try to set that up and figure out how to request a loan and so on. And I can't even imagine on the side of the lender what exactly he's taking as collateral. Is it another coin? What is it exactly? So long term, I think just from a capital perspective, it may be faster to deploy instead of like wire transfers. But maybe I don't know enough about the Web3, style lending, the DeFi lending. I know a little bit about it, but to me it appears just sort of, messy, I guess. Maybe just like the books of private companies, of small private companies, maybe in the mess there is an opportunity. But currently, for me as a private lender, or the companies that I deal with, it's not in the radar right now. And it's not as if I deal with I basically deal with the crypto generation. Maybe 70% of my loans are to people between like 20 and 25-year old. So it's all people who know about crypto, they know about the NFTs, they know about all that stuff, and they still don't go that route, or they still don't know that route. It's not as if I'm dealing with a very old company that has like senior executives and everything, and that they barely know what crypto is, they barely know what Bitcoin is. I'm literally dealing mostly with millennials and Gen Zs. So they know about crypto. So far, I don't exactly know what will be the path for it to dramatically change the style of lending that I do, or take care of the style of client that I take care of. Potentially for global style of lending where banking infrastructure is lacking, maybe. But it comes back to what I said initially, which is that it may simplify the movement of money, but I don't know about the quality of the loans and the quality of the infrastructure. I don't really know about that. Maybe I just don't know enough about DeFi to comment further.
All right. Thank you so much for the honest input. Do you have any final words to give our listeners?
Final words. I could say so many things. I would say the core principles to invest often, invest early, take on risk, especially when you're young. You can always make it back. And whatever money you think you have today is not going to be much, in 10 years. So take the risk, grow, and spend less than you earn.
Thank you so much. And here you have it, Louis Bachour. He said, whatever money you have right now is not going to be much in 10 years. And remember to take the risk. Thank you so much for the insightful session. That wraps up today's episode of Web3 Unfiltered. A big thank you to Louis Bachour for breaking down how private capital really works, how risk is evaluated beyond traditional banking systems, and how founders can position themselves when the convenience route closes. Until next time, stay sharp, stay curious, and keep building.